So yeah, thank you very much for taking the time for joining. This is the first roundtable that CEP is organizing on the reform of tax expenditures. We start a series within the series in the sense that we will have 3 events focusing on Europe. This is the very first one where we will be looking at corporate income taxes, and we'll have another event on consumption taxes next week, same time, and the week after, another event on personal income taxes. So looking forward to you also taking part of those ones. Yeah, as I said before, a bit of housekeeping rules. So the event will be recorded. It's being recorded actually, and it will be posted online on our website, cpweb.org. I hope you're all fine with that. Remember, you are muted by default, so please unmute yourself whenever the floor is on you and mute yourself back when you're done. And whenever you want to intervene, particularly in the second part of the event, where it will be more a panel discussion, use the raise hand functionality. I don't know if you're all familiar with that. It should be in the reactions tab that appears in the menu at the bottom of your screen. Yeah, someone is already using it. That's great. So that will help to kind of organize the session. Otherwise, just wave or turn your video on. So yeah, so why are we organizing this event? So as you all know, here tax expenditures are a valid policy instrument used widely to pursue different policy goals. But yet, these are also very costly, often opaque, and based on the limited available information, they are very often ineffective and also can trigger externalities or undecided effects. So let me dig a bit deeper into these 4 aspects of tax expenditures I just mentioned. The fiscal cost is very significant. Just to give you a bit of a grasp of the idea, on average, the tax expenditure to GDP ratios in Europe, on average, is around 4.5 percentage points. That's a lot of money, but can be as high as 13 percentage points of GDP in the Netherlands and more than 12 in Finland and Czechia. So that's clearly a lot of taxpayers' money that we think should be scrutinized in a better way. So despite their magnitude and the fact that their net impact on government budgets, if you want, is similar to direct spending entitlements, the lack of transparency that we observe is striking. This is true at the national level, where very many European member states do not report on tax expenditure, the revenue forgone through tax expenditures. There are at least 3 EU member states, Cyprus, Luxembourg, and Malta, that do not report at all. And another 5 provide some very limited information on the revenue forgone of tax expenditures. This is the case of Czechia, Hungary, Portugal, Romania, and Slovenia. In any case, at least these 8 countries are clearly breaching the Council Directive from 2011 on requirements for budgetary frameworks of the member states, stating, and I'm quoting, that member states shall publish detailed information on the impact of tax expenditures on revenues. So at least for these 8 cases, this is not happening. On top of the lack of transparency at the national level, there is also what we consider a stricken lack of cross-country comparable data. There are a few worth mentioning initiatives. Ana from the OECD will tell us about their work when it comes to tax incentives in the context of R&D and innovation, and also the fossil fuel subsidies initiative. These are databases providing some cross-country comparable data covering those specific topics. And together with the colleagues from the German Development Institute, and Christian is present here, we have been working intensively on the global tax expenditure database, where we will try to fill this gap. And as the name of the project is self-explanatory, we'll try to provide data on tax expenditure reporting of all countries across the world and covering all tax bases and policy goals. So keep tuned, we will let you know, but this is coming very soon, hopefully. And as a result of this lack of transparency, what happens is that many tax expenditure provisions are hardly ever subject to a sound analysis, empirical evaluations or assessments, whether we can actually have an idea on how effective they are in pursuing or reaching their stated goals, and also, and even less, we are able to understand or internalize the negative externalities that they can trigger. So we think that the reform of tax expenditure is vital for these reasons, and this is true in general, but also and particularly true now with the urgency that many governments around the world are facing with the impact of the COVID-19 and the need of additional resources to fund recovery packages, for instance. So we think that governments cannot afford to lose revenues to ill-designed tax breaks, creating loopholes that contribute to strategic tax planning and tax avoidance strategies. We also think they cannot afford to continue offering tax deductions that have a negligible impact on activity, but end up triggering costly windfall gains for a few big players. And certainly they cannot afford to maintain tax incentives that harm the environment and thus the sustainability of societies. So this is what we have in mind. And with this event, or this series of events, we would like to understand the political economy behind the reform of tax systems, what are the potential benefits of such a reform, but also which are the challenges or barriers to get there. So with this in mind, and I will stop here, today we will be covering or focusing on three main topics. The role of tax incentives in the debate regarding harmful tax practices and harmful tax competition. This is crucial in the context of the OECD work and the BEPS project, but also social civil society organizations like Tax Justice Network, Oxfam, that are present today as well, having worked intensively on these topics. Also the use of tax incentives to boost R&D and innovation. And I would like to particularly hear our speakers today about patent boxes, which is a controversial one, but at the same time very fancy in Europe, among European countries. And the use of tax expenditures to support the consumption and production of fossil fuels. So those are the three main areas that I will like to discuss. So we will first hear from our speakers a few introductory remarks. And as I said before, we will move into a more dynamic panel discussion setting right after. So yeah, let me give the floor to Ana. Ana Cinta González Cabral is an economist with the Tax Policy and Statistics Division with the OECD. So Ana, the OECD has a prominent role in the international tax arena, that's clear, leading, for instance, the efforts of the base erosion and profit shifting project. And Action 5 within the BEPS package deals with harmful tax practices. That's a key area in there. So can you please give us an overview of the work of the OECD on the use of tax incentives as harmful tax competition instruments? Please, Ana.
A question of clarification, Agustin, would you like me to do the introductory remarks now, or would you like me to kick off with the couple of questions that we discussed?
It's up to you. If you can give us an overview on the role of the work in that area, or...
Perfect. So I think let me start with maybe like giving some introductory remarks on tax incentives in general, and I think that will help me also shape the areas in which we have been working lately. So the COVID-19 pandemic, as Agustin has said, has hit economies very hard, has led governments to introduce significant fiscal packages to first contain and mitigate the impact of COVID-19 in households and firms, and then to provide fiscal stimulus for recovery. And as we have discussed, well, public finances have suffered, and there is a need to mobilize fiscal revenues. And what this has provided us is an opportunity for governments to reassess not only how we can restore public finances to the way they were pre-pandemic, but also how we can use this crisis to build back better. And in this context, it's a critical opportunity also to look at our tax systems, reevaluate the policy tools that are in place nowadays, and even implement new ones that can help face other challenges, for instance, like that are still ongoing despite the pandemic, such as climate change and increasing digitalization of the economy. And this series touches upon a very relevant issue, which is the use of tax incentives. And following the crisis, this has regained like a very prominent profile in the public debate. Once, because some governments are using tax incentives again to boost certain types of activity or to try to move their economies into recovery, and as part of these recovery packages. And on the other hand, there are countries that look at their tax expenditures, and as you said, sometimes they're very costly. And we look at the current time and thinking with the public that we have, maybe it's time to revise some of these tax expenditures. So in these few minutes, what I will try to do is give an overview of the role of tax incentives, how do we use them, what are the risks, and what key pieces we need to have in place if we want to implement them. So corporate tax incentives can be thought of targeted provisions that gives taxpayers a conscious deviation from the standard tax systems. And governments can make this for different reasons. So one could be to incentivize a certain type of investment or activity, sometimes a sector. Others could be to capture certain types of positive externality. And in here, this is where we place the work on R&D and R&D tax incentives. There's a market failure. That's how we rationalize it. There are spillovers. There's a risk and uncertain nature of R&D that makes that the private return is not perfectly appropriable. So therefore, in the absence of any intervention from the government, there would be an underinvestment in R&D. This is the economic rationale behind R&D tax support. And the third reason why these type of incentives might arise, so I've named incentivize certain type of investments, capturing certain positive externalities. The third one would be to attract a certain type of investment or a certain type of investors. But if we discuss tax incentives, I mean, it's very broad, right? Tax incentives for CIT take many different shapes, and they can alleviate the cost of investing for the firm, or they can directly affect the profits of firms. And here, this is what we call income-based incentives, and that's where we would place the type of regimes that Agustin was mentioning before, such as patent boxes. So incentives in general can operate on the tax base. They can be accelerated depreciation for investment. They can be tax allowances. They can apply to the tax liability, so they can take the form of tax credits, or they can have an applicable tax. They can apply to the tax rate. And here we would have incentives such as tax holidays, which completely forego the revenues for a certain amount of years. They could act as reduced rates, so you don't observe the standard rate, but like a reduced rate on your income. Or you can have certain types of regimes, such as IP regimes, where you would apply a preferential tax treatment to the income of a certain category of assets. So all of these design features make tax incentives very heterogeneous. So when we talk about tax incentives, we need to know what type of tax incentives are we talking about, what's the rationale, what are they used for, what shapes do they take. And because basically all of these design features make them not have the same implications. So first, with respect to how they incentivize the activities, for instance, if you provide a cost-based incentive, there is a direct tie with the substance. If you provide an income-based incentive, the indirect is more indirect, the link to the incentives, investment is less clear. But it also affects what the extent of the subsidies they provide to firms on their investment and what the toll would be on public revenues. So for instance, if we think of the example of a tax holiday, you forgo all the revenues. If you think about cost-based incentives and the amount that you invested, then basically that's more limited. That's linked to an investment of the firm. But both the subsidy that you give to the firm and the impact that it has on public finances, as I said, like it's very affected by how you design these incentives, because you can have limitations, you can have ceilings that basically help you have a lesser impact on the public finances of the government that's providing this, plus also trying to target a little bit, like as much as you can with a market-based incentive, the firms that would access this provision. And again, with this idea that tax incentives are quite different, and we need to take that into consideration when we talk about tax expenditures. It's also that the geography of tax incentives is also quite different. If we look at, for instance, tax holidays on special economic zones, they would be quite extended among developing countries, well, not so much among OECD countries, whereas investment allowances and tax incentives, both for expenditures and income, would be more prominent within OECD countries. So we also need to think that if they're well-designed, tax incentives can also be a useful tool in achieving a specific goal. So one can think of incentivizing certain types of investments in low carbon technology to facilitate the transition, or one can design an R&D tax incentives that's effective in promoting additional R&D expenditures. All this depends on the framework where this is introduced, on the design of these provisions and other factors that basically impact R&D and uptake. But evaluations of, for instance, expenditure-based R&D tax incentives by tax administrations, and also research on these incentives, they have proven that these provisions are effective in providing more R&D investment, and particularly for certain types of investments, such as, for example, applied research. We also need to think that tax incentives are only one instrument in the toolbox of government. So, for instance, you think about there are other measures such as direct measures of support, for instance, grants, but there are certain advantages of tax incentives with respect to those. For instance, being less costly to administer, but not without costs, being less discretionary, and they can finally be complementary tools. No? So most governments, for instance, in the R&D space, they combine direct spending with tax incentives as they are different, completely different in nature, and they are there to achieve different outcomes. What's the downside? Well, the downside is sometimes the case for the use of a tax incentive, and I think that's why we're sitting here, is that the case for them is not very solid, or they're not used as intended. And sometimes there might be better instruments or better ways in which one could achieve the same outcome. And I think I'll circle that back to that in the end. But if you think about the risks of downsides, as Agustin mentioned also, like they can be quite costly to the governments. They can subsidize investment that would have happened anyway, so leading to windfall profits for investors, being very costly to governments where these revenues can be utilized somewhere else. And in some cases, additionality is quite limited. With tax incentives, also the market base is harder to forecast what the impact will be on public finances, and that speaks to the stability and the predictability of the tax base. And lastly, we have also a lack of clear reporting vis-a-vis direct measures of support. If one looks specifically at the conversation on the R&D space, policymakers are also typically concerned also when talking about R&D tax incentives about them being market-based instruments. There's a lack of the directionality of R&D and innovation towards activities that would actually generate a higher social return. And a second item that's a bit of a concern for policymakers in that space would be the relabeling of R&D expenditures and the cost that brings to the tax administration. But I mentioned also earlier another cost, which is the use of tax incentives to attract certain investments. And this has become very clear with the globalization of the economy. The increased connected nature of activity has given MNEs the flexibility to locate their activities where it's more advantageous. And tax is actually one of the factors that affects location decisions. It's not the only one, but it's one of them. And to this, we need to add the increase in digitalization of the economy and the growth in intangible assets, which has also increased the share of mobile income. And this has been, there are trends documented in the literature already on tax competition about the declining trends on statutory rates and effective tax rates. So obviously tax incentives raise these concerns, whether they are used to compete for real investments and mobile income activities. And when we look at tax incentives to attract foreign direct investment, what we see is that they come at a great cost for governments. There is a great amount of revenue forgone, and these are much needed resources for domestic resource mobilization. If you look at the empirical evidence on their additionality, there is basically not that much evidence on new investment being generated, like it's more fruitless investment that changes hands, or that can even displace domestic investment, not generating a level playing field between domestic and MNEs. And sometimes it's hard to pin down the rationale for these incentives. For instance, in the case where you have location-specific grants, this type of incentives wouldn't really have a place. What we see is also sometimes a large many of tax incentives that's not evaluated, and that can lead to this redundancy. And if we speak about tax incentives that compete over geographically mobile activity, then one of the key topics is, as we were saying, IP regimes that have been increasingly used over time. And here the OECD has been very active on this space through the through the BEPS project, and specifically Action 5, which looks at having aligning the tax benefits from these regimes with the location of the activity, so that the benefits arise where the substance occurs. And this is the concept of nexus compliant regimes. Has been a change in the policy space from that moment onwards. And I can delve more into that as we go along. But I wanted to say also that we've basically laid out the cases where anti-tax incentives might be effective on some of the risks. But then just to maybe have an idea of then when would they be useful and how could we design them. The first thing to note is that there needs to be an economic rationale for this support. There needs to be a policy goal that needs to be matched, and it needs to be designed in a way that fosters both the local economy and protects against harmful tax practices. And obviously in a way that social benefits outweigh the cost of these incentives. So it's important to make both an ex-ante evaluation of the cost benefits of the incentive, what's the foregone revenue, what's that administrative costs for tax administration, the compliance costs. And this might be followed by like ex-post continuous evaluation to ensure that the policy is working well and still it's relevant, basically. And as Agustin said, also like it's also important to have good reporting of these tax expenditures, also to see to have more transparency and more accountability on this front.
So Ana, thanks a lot.
Yeah.
Let me stop you there because we will come back to many of the things that you already introduced with these nice introductory remarks. So thanks a lot. And I agree. I mean, definitely there are many tax incentives that make sense. What I think is that very often the design features are crucial in determining whether they are effective or not, and the social cost are larger than the social benefits are larger than social costs. The problem is that very often we cannot get there to get these evaluations because just the data is not there, or there's no political will to increase transparency, and those are exactly the aspects that we would like to also discuss today. And one actually a key feature is how we define which tax incentives are harmful in the context of the tax competition arena, right? And besides the work that the OECD has been doing in that area, there are other organizations that has, for instance, Tax Justice Network that has also been very intensively working on harmful tax practices. The definition, as I said, I think is crucial, and it's not clear-cut always what we consider as a harmful tax practice and we don't. And that difference in concept that might exist out there might trigger differences in the approaches taken by different stakeholders, right? So Lucas, if you can please kick in and tell us a bit about the approach that the Tax Justice Network has taken on this note, and maybe if you can, highlight the role of tax incentives within the harmful tax practice debate from the TJN perspective.
Yeah,
Lucas.
Thank you. So I will share the screen now. I will start by explaining like what is like the general framework to assess what is like a tax incentive. So there are different ways to assess them. First is like through like the laws, tax laws, then by the expenditure side when the data is available, as Agustin said, and finally through the work of other people like the OECD. For our work at the Tax Justice Network, we focus on laws, and we approach those through sources like IBFD, PwC, Deloitte, and when there is doubt, the relevant laws and regulations. A very important factor in our analysis is that we take an absolute approach, meaning that we compare all jurisdictions to one standard, or that like the question is a question that applies exactly the same regardless of the country. So for example, with regards to royalties, it would be what is the lowest rate applicable to royalties accrued in the jurisdiction. A relative approach would be to comparing like a specific tax treatment in a jurisdiction to the general tax treatment in that same jurisdiction. So for example, are royalties taxed at a lower rate than other types of income? So it depends what, how are these other types of income taxed. So like the consequence is significant. For example, in the case of Hong Kong, Seychelles, and Costa Rica, the OECD says there is no patent box. At TJ, we say that there is a patent box, because the legal reality is that foreign source royalties are taxed at 0% because these three jurisdictions have a territorial approach. Second, as Anna mentioned, we follow this cost-based and profits-based approach. Basically, we disregard in our assessment of harmful tax incentives all those that are cost-based, because they may generate investments that would not otherwise have been made. And on the contrary, profits-based tax incentives make an already profitable investment more profitable. So yeah. So like further zooming into like the specifics of tax incentives, we differentiate, as Anna mentioned as well, those incentives that are limited in time and in space. So in space, economic zones or administrative subdivisions. For example, in Spain, Ceuta and Melilla are taxed at like lower rates than the general territory, or in the UK, Northern Ireland, and so on. For this purpose, we consider that like incentives that are provided for more than 10 years are permanent, because they provide like a certainty akin to that of a government that passes a law. Maybe like the government is changed like after 2 mandates and the law changed. So we assimilate more than 10 years to permanent. And more specifically, with regards to investment funds, we have kind of like a more specific approach, because sometimes the exemptions that are available in this sector are not as transparent, to use the word that is often used. So like there can be like different types of exemptions. Like first of all, you define that a company that undertakes investment activities is tax exempt, so the entity is exempt. But there could also be constructive exemptions, such as exempting all or most of the income streams that the investment fund has. So at the tax justice network, we consider that it is equivalent. For example, if a company earns tax exempt dividends, interests, and capital gains, we consider that investment funds are tax exempt, even though there may be residual sources of income, such as management fees. More generally, at the tax justice network, we believe that there is no overarching reason to decide that investment funds should be tax exempt, because it is, after all, an economic activity that is akin to any other. So it's human spending effort in an economic activity that in many cases is of a speculative nature, and there is no reason why such activities should be taxed at lower rates. If people want to invest, they can invest directly. Yeah, so finally, to do a overview of what was the data for us in 2019, we are about to publish the 2021 version. So yeah, you can see that capital gains are most often exempt, foreign investment income as well, and tax holidays, as Ana said, they are very popular in Africa. Yeah, and here we can see that the investment sector is very, very often tax exempt. Okay.
Thank you, Lucas. Very helpful. Thanks a lot. And there's also Oxfam that has been working in the field. Clearly, the harmful tax practices debate has an impact on, for instance, the EU tax haven list. We know that the European Union, this has been controversial for a while because the European Union excludes its own low tax jurisdictions such as Hungary and Ireland. Even though when they have been cited by the same European Parliament as having tax having characteristics, so this is clear. And we have all been following the last days the Open Looks case. This still to be defined how big will be, but it looks big. So I would like to see or to hear from Henrique, how should the definition of these harmful tax practices be updated in order to ensure compliance and combat tax evasion by multinationals, high net worth individuals in the view of Oxfam? Henrique,
okay,
please.
well, first, thank you very much for the invitation. I'm here representing Oxfam. There are a couple of other colleagues and former colleagues that have also worked around this topic on this call. So I would also like to thank them for all of the work. And I think the big issue here is that, let's say, besides of a review of the concept of what constitute a harmful tax practice, there's really a need also to review the broader EU tax haven list procedures. I think it's pretty clear when we see the countries that are included on those lists and the countries that have been removed in the latest, let's say in the latest updates to those lists, that there are some structural issues that must be addressed. When we are talking about, let's say, the assessment that is done for third countries outside of the European Union and for member states, there's also a clear case that there must be an equal application of concepts. So when we are looking into what the Code of Conduct does for EU member states and what is done for the EU tax haven list, there must be a single, a single standard. Otherwise, non-EU countries will always look at the procedures of the EU with let's say reasonable and legitimate questions about the different weights being utilized there. I think it's very important to have in mind that just last year in July, the EU Commission it has agreed to review the Code of Conduct for Business Taxation, which is the criteria for non-cooperative jurisdictions and for harmful tax regimes. And this discussion is ongoing, and we expect it to go a little bit further in 2021. It's currently being carried out by the Code of Conduct group in the Council. The need to review the, let's say, the concept of harmful tax regime is also because the EU still utilizes a definition of what is a harmful tax regime that was developed in 1997. So I think we all can agree that there has been clear changes in the economic landscape and how international taxation is understood by the public audience and by different sectors of around public policy that require that there must be an important update to these criteria. So I will go through a couple of points that we could classify as Oxfam main recommendations that should be taken in consideration. So the first point is that, again, the same criteria must be utilized on the code of conduct for member states and on the EU non-cooperative list for third countries. There's one very good example, recent example, which is Malta, which last year it was assessed by the Global Forum on Exchange of Information as sufficiently compliant. At the same time, the EU, when it is assessing third countries, it requires that those countries be at least largely compliant on this transparency point. This is quite interesting because what the EU, let's say, utilizes as the minimum necessary for third countries is not being observed by Malta itself. So as a result, for example, Anguilla has been blacklisted for this specific point, but Malta was not held accountable for it. So there is this need to have the same criteria there. Second point would be, well, the harmful tax regimes, they really focus on the point of being a preferential regime, yeah? So there, it's always, for example, looking into if a regime treats differently non-resident taxpayers and domestic business. And based on that, that regime would be considered harmful or not. This leads to a lot of strange situations. So for example, Barbados, a couple of years ago, it had a preferential regime that basically established for international companies a very low tax rate between 0 and 3% and a 30% rate for domestic businesses. After the EU blacklisted Barbados, Barbados changed its regime and removed the preferential character. So it basically established a 5.5 rate for small companies and a 1% tax rate for big companies. So while of course the regime is not preferential anymore in the sense that it treats domestic businesses and international business differently, it does not resolve the main issue about how harmful that situation is. And this, of course, we can also see another point really importantly is that 0% tax rates or very low rates, they must be seen as a standalone criteria about what is a harmful tax regime. So in October of last year, for example, the Cayman Islands, they were removed from the blacklist. The Cayman Island has a 0% corporate tax rate, and it has been recognized by the IMF as one of 10 economies that host 85% of all phantom investments, or FDI in the world. So it is a very clear case that the criteria is not correct in that point. Another point that Oxfam has been mentioning for a number of years is really that there must be an economic analysis to assess if a regime can be considered harmful or not. So the level of FDI, both inward and outward, and also the amount of passive income compared against the GDP of the country must be taken into consideration. As I just mentioned, the IMF, it demonstrated that 10 countries, they're responsible for 85% of all phantom investments. So this includes the Netherlands, includes Ireland, Luxembourg, and 7 non-EU countries. And none of those 7 countries are currently blacklisted. So it is important that a new and updated criteria looks the specifics of the economic factors of a tax regime. Another point we would like to mention is the need to review the concept of economic substance. So for example, the Netherlands, according to the Dutch Office of Statistics, it has around 14,000 letterbox companies in the countries. So those are companies that mainly have no staff, no physical presence in the country, and that mainly benefit from the Dutch tax treaty network. Another point, and I believe we're going to have the opportunity to discuss patent boxes further ahead, but the definition of harmful tax regimes must be expanded, and Oxfam clearly believes that patent boxes must be included as harmful tax regimes. As you all know, patent boxes are very popular now in Europe. By 2018, there was an estimate that 15 of the 28 member states in the EU had patent box regimes. As was mentioned by Ana Cinta and by Lucas, there is a clear distinction between cost-based incentives, so let's say R&D incentives that actually promote more investment, and profit-based incentives like the patent box that don't promote new incentives, but just lower the tax rate of already profitable operations. So patent boxes, they do not increase investment or do not create real economic activity. They are mainly large tax cuts for multinational companies. So they should be considered harmful tax regimes. Another very important point is when we're looking at developing countries, there must be a flexibility at how the EU sees and how the EU assesses developing countries and their capacity to actually implement some of the required issues. It's important to have in mind that the current criteria, it includes the adherence to the BEPS minimum standards. Developing countries, they were not involved in the discussions, they were not involved in the design of those BEPS standards. So they should not necessarily be punished for not adopting those standards. This has previously happened with Namibia and Mongolia, for example. So it is important that there is some flexibility around that. Also, besides, let's say, the fact that those countries were not part of the design and of the discussions of those standards, also a lot of times developing countries, they simply do not have the technical capacity to implement those standards. So clearly they should not be punished for it, but they should receive some form of capacity development assistance there. Another point would be the inclusion of criteria based on beneficial ownership transparency. This apparently is already under consideration, and we hope that it is promptly introduced as well. And finally, we would also say it's very important to increase the overall transparency of the Code of Conduct group. So there needs to be clear publications, clear transparency around how EU member states are assessed. We currently have for the non-cooperative list for third jurisdictions, a high level of debate and transparency and publications when there are changes, and the same should be expected when member states are being assessed here. Well, Oxfam's view is that basically, and above all, this really is a matter of political will within the EU. And these, let's say, those changes, those improvements, they are necessary because currently the EU list, it simply lacks credibility for a lot of developing countries, both by government and also by local civil society organizations. They see the fact that their countries or other non-EU countries are being punished by, let's say, by fiscal policies that still exist at the heart of the European Union. They just see that as a clear case of double standards. So as long as there is this clear mismanagement of the situation, the EU and its efforts will not be seen as credible by third countries.
Thanks a lot, Enrique. Very comprehensive. But you did mention patent boxes, and that gives me opportunity to introduce Ron. Ron Davies is professor of economics with the University College Dublin, and Ron is actually a specialist in the topic. So Ron, your latest paper, Patent Box and the Success Rate of Application, actually digs deep into these issues, right? And not only in how much additionality or R&D and innovation patent boxes can trigger or not, but also you go one step further, taking a look at the quality of innovation, which I think it's crucial and sometimes overlooked, right? So if I can give us a bit of the first insights of your research that would add value to the conversation, that would be nice.
Cheers. Yeah, I do a lot of research on tax issues, but I really consider myself a trade economist. I do a lot with international trade. I do a lot with trade policy. I do a lot with FDI. And when you mess around with FDI, you mess around with taxes. And the way I got into the patent box stuff is, when you talk about FDI, you talk about tax competition, and people were talking about these patent boxes as kind of the latest way of engaging in tax competition for foreign investment. And this has already been alluded to by Ana, Lucas, and Henrique as well. So I started going back and reading about these things, and a few things became very clear to me fairly early on. So first off, the governments all say that this is to encourage innovation, whatever innovation might mean. And why do you want to encourage innovation? Well, there's lots of reasons. So the European Patent Office just put out a study that even for SMEs that have patents, their wages are about 50% higher compared to comparable firms. Revenues are about a third bigger. So innovation is in one sense a good thing. One of the other things on the agenda to talk about today is the consumption of fossil fuels. If we're going to maintain anything like our current standard of living, such as it all is as we sit in our kitchens, we need to innovate if we're going to have any sort of environmental quality as we do that. So there are lots of reasons to innovate, but that's not what patent boxes do. Patent boxes encourage firms to patent, which is a very, very different thing. Only about half of patent applications ever get granted. And it's expensive to patent. So the application fee itself is not that much, but you have to hire a legal team to help you write the application. In Europe, if you get it granted by the European Patent Office, you still need to go country to country and register your patent. And that can cost easily 100,000 euros plus. And you have to renew it every once in a while, otherwise your coverage will expire. And so what this does is it gives firms an incentive to get a patent, because for those who aren't super familiar, what a patent box does is you declare this income was earned by this patent, and then the corporate tax rate you pay gets cut in half. And so without the patent, you don't get anything from this. And so this has been alluded to, calling it a cost-based incentive, such as a subsidy to do R&D versus an income or a profit incentive, which is, okay, you came up with an innovation, we're going to tax the income from that less. I personally tend to think of it as an ex ante incentive before you start, and an ex post incentive after you've succeeded. And what patent boxes do is they reward this one measure of success, which is getting somebody in the European Patent Office to say, okay, that idea is sufficiently novel to warrant granting a patent. And so when I came at it, starting to read in the literature, the evidence is reasonably clear-cut that patent boxes increase the number of patents in a country. Now, that in and of itself can come from two ways: more innovation or bringing innovation from a different country. And so there's work by Schwab and Totenhaupt, for example, or Nadine Riedel and co-authors, that there does seem to be a bit of stealing R&D activities from other countries. Multinationals in particular, so Henrique already brought that idea up, are shifting patents to be held in low tax countries such as Ireland, where I live. And so one of the things that we've tried to do is push nexus requirements that say in order to qualify, you have to do at least a certain amount of the cost of R&D in the country to use that country's patent box. So, the number of patents might be going up, but my response to that was sort of, well, so what? Are they good ideas? Are they actually innovative ideas? And so governments love to talk about okay, we're going to implement a policy that will increase the number of jobs. Well, I could do that right now by defining a job as 20 hours per week. Now everybody has 2 jobs for the same pay. I've doubled the number of jobs. I'm a great politician. But that's not actually achieving what we wanted out of it. So how do you measure the quality of an idea? Well, one way that you can actually observe is whether or not the application is successful. So when you go to the EPO, you go to the European Patent Office and you submit this thing, do you actually get it through? Does somebody say this thing is novel enough? Now, why would patent boxes influence this? So there are 3 different ways it could do that. So the first of these is that when you go to apply, you hire lawyers who help you write your patent application. So this is the patent prosecution team. You could hire better lawyers for more hours to write you a better application. That might get it through. And that's an effect that can happen very quickly, because once you come up with the innovation from first use or disclosure, you have 6 months to apply to the EPO. And so, if these patent boxes are operating through this channel, it should happen pretty quickly. The second possibility is, it leads firms to work harder to come up with cooler ideas, more novel ideas that are more likely to get through. Now, if that's the motivating force, that's going to take a while to show up, because it's not like you go down into the basement, come up a couple of weeks later with a brilliant idea. These things take a couple of years to pull off. The third, and this is one that's been raised as a potential concern, is that what it gives firms an incentive to do is just submit a bunch of crap. Every idea you came up with, throw it in the mix. Hopefully it gets through, and then you can get a tax break on it. So what it would do is actually reduce the average quality, the average novelty of applications. And so the success rate should go down following a patent box. So we take this idea to the data for EPO members, and what we find is that the probability of success after a country puts a patent box into place actually goes up. And it takes about 2 years for that impact to happen. So while there may be some firms throwing random applications into the mix, that's not the driving force. If all it was hiring better lawyers, that should happen way faster. It really is about 2 years before you see any kind of effect. So this really suggests that it's firms coming up with more novel ideas. Now, does that make them good? No, not necessarily. Like, I don't know, think about music, right? I'm a big jazz fan. What I think is novel, a lot of people would listen to and go, that is not music. That is not good. That does not benefit society. But there's that issue. But the other aspect of it is, where are these better, more successful applications coming from? It's the top innovators. 80% of patent applications come from the top 5% of innovators. Most firms that submit a patent application will do so once. About 2/3 of applicants will submit one application ever. Patent boxes don't do anything for them. They impact those at the top 5%. Why? Well, there's probably a couple of reasons why. First off is, this is an ex post incentive to innovation. For a small firm, the problem they have is, okay, I could go down and I could spend 2 years doing R&D. How do I pay for that? The upfront costs of the research are really problematic for them. Yeah, if I get successful, great, I get to keep more of my profits afterwards. But it's that upfront cost for the small, financially constrained firms. And that's where these ex ante or cost-based incentives, even in our data, what we find is that what benefits the small guys are the upfront subsidies. The patent boxes are at the other end. And so it's the firms perhaps with the deeper pockets that can afford to hang on 2 years until they really start making money off of this idea. So that's one possibility. But the other aspect of it is the way the patent boxes work is, I have to say that this income goes with that patent, and I have to justify that. What do we know from the transfer pricing literature? Most firms don't really do a lot of transfer pricing. The big tax avoidance is coming from a handful of big firms active in tax havens. Why? Because they're doing the advanced pricing agreements. They've got the ability to hire teams to swamp policy officials and justify why this item I am selling to myself should go for this price to move profits around. The same thing's true with patent boxes. You have to justify why this income goes with this patent. You have to justify why that patent qualifies for the patent box, because which costs go into making it with these nexus requirements. And actually, this is the one good thing that, in terms of the approaches that we've seen, this effect that we're getting only comes from boxes with the nexus requirement, where you have to do the R&D locally. And so if we think about the way these patent boxes are working, I hate to say it, as somebody that lives in a country that has a patent box, it really does look a lot like transfer pricing. it really does look like competition, because who's taking advantage of it? The big guys, probably the multinationals. Let's just be honest about that. And how are they doing it? They're justifying why what they're doing qualifies using the exact same approach that we've seen for transfer pricing for years and years and years. And so, what is different about this? Well, transfer pricing is just saying like, oh, well, I'm doing it because it seems like a good price. But this is coming under this justification of trying to increase innovation. If innovation truly has positive spillovers, then this gives us the opportunity to use this to encourage something good and get more of. If individuals don't internalize all the benefits, that gets us closer to what we might actually want. And is it really doing that? It's not clear. But that creates a political justification for it in a way that transfer pricing doesn't. And so for me, that's kind of a big distinction.
But thanks a lot. That was very useful. But if I can be provocative here,
oh yeah,
and based on what you just exposed, right? As I see it, a patent box. I mean, if I was a politician, would rather be a tax benefit for a few large players, probably multinational in specific sectors, that are the more likely to file patents at the end of the day because it's very concentrated, and if any, the best case scenario is that would trigger patent filing in my jurisdiction, probably picking or taking those patent filings from somewhere else. But the impact on real R&D and innovation, as you said, it's at least in the best case, not for.
Yeah.
So,
and it's tough because how do you measure R&D? How do you measure innovation? So, I remember back when we got to go places, I went to see a rugby match with a friend of mine who's also an academic and his brother-in-law. And I said, Jim, what did you do all day? He said, I did research. And his brother-in-law was like, no, you didn't. You sat and you stared out the window all day. That's kind of what innovation looks like a lot of the time. How do you measure that? You can't. So what do? We try to measure R&D expenditures, which in and of itself we know can be manipulated. What's nice about patents, they're easy to count. Just go to the EPO, go to Google. You can look them all up. And it becomes an easy way to point to, just like, oh, I created 1,000 jobs. Oh, we generated 1,000 patents. And it's an easy way to justify things. Now, does that justify the reduction in government income? Does that justify some of the other things that are happening? That's a totally separate question. But yeah, it's a slippery concept.
Yeah, thanks, Ron. And let me bring Ana on board back again, because the OECD has the R&D tax incentive database, and also has a database providing cross-country data on the support for fossil fuel subsidies, right? These are two initiatives that provide certain level of cross-country data. So Ana, can you please give us some initial insights, similarities, differences, challenges on the two initiatives, and how they, how do you lead the work in the international tax arena on that note?
Thanks, Agustin. So
I think you're muted, Ana.
yeah, this is like 2020 wasn't enough for me. I need 2021 to remember these things. So as I was saying, you didn't hear, the R&D incentives, as you have seen, like they are different types: expenditure based and the income based. So from like for a long time already, the OECD, actually their colleagues in the Directorate of Science, Technology and Innovation have been working for quite a while on measuring expenditure-based R&D tax incentives. So there they look at the design of these incentives over time, and also of the cost to the government, so the direct cost to the government. How do we do that in terms of foregone revenue? So that's what's coming into from the expenditure-based side. We've partnered with the Director of Science, Technology, and Innovation. So I belong to the Center for Tax Policy, and now we are looking together at what the effect of R&D tax incentives expenditure-based are on the effective average and marginal tax rates of firms. So trying to build a comparable picture of what these different subsidies, how do they affect firms. That's from a design perspective. And we have a paper coming up very soon where we do have that comparison, as Lucas was saying, relative also to the baseline tax treatment, trying to see how the deviation is from the baseline tax treatment and also across countries. So that's one initiative where we are collaborating, and there we have, as I just said, the design side of these incentives, which are very heterogeneous, and the costs. And we are now working on the R&D tax incentives based on the income-based side. So basically, to complete the picture, we want to do exactly the same thing. So we want to look at the design of these income-based incentives over time, the change being in terms of Action 5 and the nexus requirement, as we have seen, being that requires you to do to obtain the tax benefits from the patent box. You'll need to have the R&D done in the same jurisdictions. That would be one key policy element we'll be looking at. And similarly, we're going to look at how a cross-country comparable tool to compare the design of patent boxes and also on the cost of these incentives to the government, how many taxpayers are using them, how much does this cost government? So again, in terms of foregone tax revenue. So that initiative, which is together with our colleagues at the Directorate of Science, Technology, and Innovation, is going to bring like a full picture in terms of tax incentives for innovation, how much does it cost to government, how much, what's the incentives for firms ultimately across countries. And similarly, as I said, like with R&D tax incentives, that was to absorb a positive externality regarding fossil fuels. I think you know the background. So in 2009, the G20 committed to phase out and rationalize the use of fossil fuel subsidies while providing targeted support for the poorest. And basically the idea was to reduce to try to like reduce reduce these fossil fuel subsidies and encourage this type of consumption, and basically it's undermining the efforts to move into other types of investment that can help us deal with climate change. So there is our colleagues at the Directorate of Environment that are keeping this fossil fuel subsidies database. But basically, to summarize a little bit what the policy challenges in that area would be that fossil fuel subsidies still are significant. Our work in this area is also completed with 2 different publications. That's our work of our colleagues from the Tax and Environment team, and that would be Luisa, that you will be here in the next session, that will be discussing a little bit more, but we have 2 different publications on taxing energy use and effective carbon rates, where we basically track the taxation of energy-related emissions. And basically nowadays, about 97% of energy-related carbon emissions are still taxed at levels that are not compatible with decarbonization. So effectively, that's basically the 2 initiatives that we have brought on board. Where do we go from with the fossil fuel subsidies and this conversation, where the package would be diminishing the amount of fossil fuel subsidies accompanied with an introduction of carbon taxes and alleviating measures to basically dampen these adverse distributional effects. So I think in principle, those are the two main topics that we are touching upon and building in parallel.
Thanks, Ana. Thanks a lot. Yeah, that gives me opportunity to move a bit into the fossil fuel subsidy discussion, because we talked quite a bit about patent box and R&D tax incentives so far. So yeah, there is this area, the extractive sector, which is a large recipient of fossil fuel subsidies, right? Often this is seen as a very relevant topic for developing and emerging countries, resource-rich countries, particularly through the great job that our colleagues from the IGF mining are doing on the topic. But yet, this is also relevant for some EU member states. and that I think it's sometimes overlooked. But I know that Tax Justice Network has done some work on that area. So Lucas, maybe you can kick in and give us some insights.
Yeah. So the way that we measure tax incentives is what I mentioned before. So we do not only measure like the tax rate reductions, but also where alternative tax regimes are available. So we didn't find in the EU any direct tax rate reduction for profits from extractive activities. However, there is plenty of alternative regimes that touch upon activities in the extractive sector, notably the tonnage taxation regime. So tonnage taxation is like an alternative tax that is available in theory to shipping companies. So each country will decide which economic activities fall within the tonnage taxation regime. So companies that are taxed under the tonnage taxation regime are not taxed under corporate income tax. So they are taxed on like a nominal tax base that is calculated in proportion of the tons, like the capacity, the tons that the ships that the company has have. So for instance, among activities that are clearly not within like the classical shipping sector are casino activities in Latvia. So it's hard to think how like casino profits will scale with like the tonnage capacity of a ship. But also, and relevant for the extractive sectors, is floating barges, exploration activities, pipe laying, and crane vessels. So like all the infrastructure that is like a mobile infrastructure that is used for the extraction of fossil fuels, and its operation by a shipping company can be taxed under the tonnage tax regime. So it's also hard to think how the profits derived from exploration, fossil fuels extractions, and transportation via pipe laying, how these profits scale with the tonnage capacity of the ships concerned. Like a crane vessel with extractive capacities can be producing fossil fuels with like a limited tonnage capacity. So like this tonnage regime that could make sense for transportation, you have certain capacity that you use for transport, is being applied to extractive activities. Quickly doing the overview for the last edition of the Corporate Tax Haven Index, I see Belgium, Cyprus, Germany, Denmark, Greece, Croatia, Malta, the Netherlands, and that's pretty much it. So like on the top of these EU countries that have this what we consider a partial exemptions, because these companies pay some tax over and above this, that there are many countries that offer full exemptions, such as Montserrat, Mauritius, Singapore, and the traditional no tax jurisdictions like UAE, Anguilla, Bermuda, Bahamas, etc. So that's for TJ and extractives.
Yeah, thanks a lot. And at least for me, without being a specialist in the extractive sector or industry, this is a novel approach. The fact that also European member states are active in that area. And another aspect that I personally find interesting is a carbon border adjustment proposal that was included within the European Green Deal. I think it's an interesting one. There might be challenges in terms of how it is designed and implemented, whether it will be compatible with WTO rules, for instance. But I still think at least it's worth food for thought, and it gives food for thought in terms of how to improve the policies that are being implemented within the European Union on that note. So I think there's potential to use the CBA as an alternative, for instance, to tax expenditures in the context of energy taxation, right? In kind of the other side of the coin, you penalize imports from polluting countries instead of giving a prize to the polluters that are sitting in your jurisdiction. So I think at least it's interesting, but I know that Oxfam has pointed out concerns regarding the potential impact on developing economies, emerging economies, particularly those that export into Europe, into European countries. This could be seen as an additional barrier for them. So I would like to hear from Henrique what's Oxfam's position on that note.
Well, I think, Agustin, that it's quite important when we are looking into the let's say into the role of the EU member states, let's say the harmful tax practices within the EU and the use of tax incentives by EU member states. What are, let's say, the negative effects on developing countries? So I think, of course, when we're talking about policy coherence, we should look not only into the impact of EU countries that they have on third countries, but as well within the EU. So, well, I would say that last year there was the publication by TGN on how, let's say, 4 countries in the EU, which I believe were Netherlands, Luxembourg, UK, and Switzerland, the impact that they had, those 4 tax havens on other EU countries. So I believe it was around 27 billion euros per year of losses, with France, Germany, and Italy as the main losers. We have to see that in the context as well of the the remarkable drop in average EU corporate income tax rates, which in '97 they were over 35%, and now in 2018 we were looking at just above 20%. So this, let's say, has a very important impact within the EU. But when we are looking, let's say, also broader outside of the European Union, there's a very interesting report published recently by Oxfam, which looks into how Total, the extractive French company, invested in Uganda through the Netherlands to benefit, in that case, from the double tax agreement between Uganda and the Netherlands. And by doing so, we have calculated that for a single extraction project in Uganda, the country might lose up to $280 million from a single project. So this, I think, shows the very important impact that EU policy has on other countries. So the fact, for example, when we're looking into Uganda, the Netherlands is the country that invests the most into Uganda, which is around 35% of all FDI into the country. But when looking closely at that Dutch FDI, we can see that around 95% of this FDI actually originates elsewhere, which is basically just being routed through Dutch letterbox to benefit from of course the tax treaty clauses. Also, if we look into Latin America, in Latin America, 1 out of every $5 invested as FDI comes basically through tax havens. So mainly Luxembourg and the Netherlands play a very a large role in that FDI. When we are looking into that, I think it's always important to, like you said, consider the impact that EU policies have in third countries as well. So I think this point, when we are looking into extractives or all other forms of incentives, it's quite relevant.
Okay, thanks a lot, Enrique. So let me move into the discussion. So please raise your hands if you have questions, comments. I've seen a few questions already in the chat, so we will be happy to take those. We have a few very knowledgeable people also in the audience as participants, so I would be glad to hear from them too. So let me start probably with a few questions from the chat, or if you want to intervene, just use the raise hands mode. But given that Ron Steenblick is here and he has a lot of experience and knowledge in the fossil fuel subsidies area, so Ron, maybe you can give us a bit of an idea of where you see the most important barriers or challenges to actually phase out fossil fuel subsidies, right? There's a bit of a broad consensus on the need to phase out fossil fuel subsidies. And as Ana just mentioned, they are still there. Let me give you just two figures. The total fossil fuels support rose by 10% year on year to 178 billion in 2019, ending a 5-year downward trend. So we actually see that the total support is increasing. So what is kind of constraining this needed reform? And you have to unmute yourself,
right.
Ron. Before
yeah, I apologize. I just came back from dropping off my wife at someplace where we couldn't carry it on the sidewalk, and so I didn't listen to the last discussion. Also, well, first of all, my name is Ronald Steenblick. I'm a non-resident senior fellow at the International Institute for Sustainable Development. I'm no longer in charge of the OECD database on fossil fuel subsidies. I retired from the OECD in November 2018, but I was responsible for getting it set up. In terms of, I presume that your main concern is about the tax-related measures, as opposed to the general subsidies. Because I mean, the one thing that was a major change in Europe anyway was the ending of pretty much basically direct traditional subsidies, grants, and so forth to hard coal mining. So subsidized hard coal mining has pretty much disappeared from the EU. And it's substantially reduced in Norway. So there has been that progress. But in terms of other tax expenditures, the big ones are, of course, the exemptions and reductions in excise taxes on fuels used in agriculture, fisheries, and forestry. And I mean, there have been a few cases. Austria, for example, eliminated these exemptions for agriculture several years ago. And there is some discussion in some countries of changing those, but these kinds of subsidies, particularly associated, or tax breaks anyway, particularly associated with agriculture, are hard to change, for one, because of the strong political lobbying of agriculture and fisheries, but also because the kinds of benefits that become incorporated into the value of land, in the case of agriculture, permits, if there are tradable permits, for example, in fisheries, they become capitalized into that. And so if you substantially raise the taxes on the fuels, then basically you're creating losses for that group. And I would say that so far there hasn't been the political will to really address those. And it's not only in Europe. I mean, you look at the United States, and for example, they have federal excise taxes on gasoline and diesel used on road. Those have not been raised since 1993. And I've been in many discussions with people who are saying, yes, we need to do something about climate. We need to reduce carbon emissions. And then you start talking about, okay, how about we start with updating the taxes, the federal excise taxes on fuels. And it's like, oh, no, there's all kinds of, that would be regressive. And there's definitely a strong lobby in the United States that's against carbon taxes, again, using the regressivity argument, even though there are ways to get around that through other flanking policies. So when you have that kind of policy that's very widespread and has a large, significant percentage of the population, and especially that has a history of mobilizing in support of the policies that benefit it. It's just politically very hard.
Got it. Thanks a lot, Ron. Very useful. So I see that Tom Neubeck, who's also present and has a lot of knowledge in this field, is asking whether some EU countries publish additional policy analysis of corporate tax expenditures in addition to the revenue forgone. So I'm aware that the Dutch colleagues, the Dutch tax administration or Minister of Finance actually, does do and publish evaluations, cost-benefit analysis on some provisions. The same for Germany. They have like a sustainability framework where they go even further and analyze the sustainability impact of some provisions. I know that there are a few colleagues from the tax Minister of Finance here, from the Dutch Minister of Finance. If you want to kick in and provide a few more details on this one, I will be happy to give you the floor. But I cannot see you raising the hand, so maybe we can just move. But there are indeed a few. It's not unfortunately the case for all countries. Ireland, maybe Ron, you're aware of that, but Ireland also does a bit of a policy evaluation moving forward by but not only providing revenue forgone estimates, but actually trying to assess effectiveness of some provisions. So there are cases, but it's not the rule, rather the exception, right? So
one of the things I wanted to jump in here and ask Ana about.
Yeah.
2021.
I think I muted, sorry.
So, so thinking about the corporate tax expenditures, when I initially read Tom's comment, I was thinking about issues of enforcement and, what governments spend in order to collect €1 worth of money. And so when Ana was talking a lot about sort of tax forgone and that being the main measure of the cost, in particular thinking about developing countries like Henrique was talking about, with things like automatic information exchange and tax treaties, the compliance costs for governments of meeting these expectations are beyond their capacity. And I don't know whether there's anything out there, a good measure of what it actually costs for a government to implement its policies. And that to me seems kind of an important thing. So like in trade, for example, this comes up fairly often because, tariffs are actually pretty easy to collect. It's on a boat, you look at it and give me the money or it doesn't get off the boat. But other sorts of tax revenues for governments are a lot harder to get their hands on. Ana, are there measures out there like that?
Thanks, Ron. So I think I was mentioning this also on the at the very beginning. No, I think like there is a difference between the revenue forgone, as you just mentioned. I think that's what we try to capture, because that's I mean, it's still very hard for tax administrations to measure sometimes, depending on how difficult these provisions are. For instance, one might think that one of the things is, for instance, if you capture them on an accrual or on a cash basis, like these type of reporting things are already difficult to basically get a complete picture and for tax administrations to do that. But revenue foregone is literally just one of the components. Like, I mean, when you're putting these tax incentives in place, there is, we mentioned before, there's an administrative cost for having them in place. There is a compliance cost for firms that are applying to these initiatives. Sometimes we have the conception that it's tax incentives compared to direct measures of support is much easier to administer, but it's basically, it doesn't mean that it's without a zero cost. I mean, especially for instance, in the R&D space, there are processes to be able to make sure and to track somehow for the tax administration to evaluate what's a legitimate R&D claim and what's not a legitimate R&D claim. And they have these pre-approval processes before the firm can claim it in certain countries. There you're talking already, there is an administrative cost for the tax administration that they need to burn and a cost for the firm as well. So, I mean, in principle, if you're doing a proper cost-benefit analysis, all this you would be taking into account, obviously, from a cross-country data perspective. So from an OECD perspective, this is something that we cannot really, like, it's very specific to the jurisdiction that's taking them on board to be basically doing this full cost-benefit analysis. And that's why we always say that we try we collect the data, but we're not evaluating the incentives as such, because we don't have the capacity to measure all these other hidden costs and benefits that these incentives might bring.
Thanks, Ana, and thanks, Ron, also for kicking in with the question. So on the fossil fuel subsidies debate, and based on Joe Summit's Lucia questions here, it's clear that there is a bit of a consensus on the phasing out of fossil fuel subsidies, but there is also the debate about the social impact if containment measures or if measures to take care of those in need that can be hit the hardest, but the phasing out of those subsidies are taken, that can even trigger social unrest, right? We have seen the case of the Gilets jaunes in France, and that's also one of the probably political barriers or constraints towards the reform of fossil fuel subsidies out there, at least of consumption-related ones, right? Basically. So I know that Oxfam has also worked on that topic. Maybe Henrique, you can briefly give us a few insights on that note.
Sure, thank you. So first of all, I think what Ronald mentioned was straight to the point that let's say the removal of subsidies or the removal of something, some specific incentive should not be seen as a standalone solution, but part of a broader approach to it. So Agustin, you mentioned now the issue, of course, in France, but we can mention a number of other countries. So for example, right now in Ecuador, the government is negotiating a loan with the IMF. And one of the things that is being considered is the removal of a fossil fuel subsidy. But there are, let's say, no other considerations about other possible social programs that can be used exactly to make this change the least regressive as possible. So I would say that while, as you said, there's a clear consensus that this is the direction to move, and there's a clear necessity to advance in the removal of those subsidies, it's very important not to see those removals as a standalone policy, because then, of course, the poorest in society will be hit disproportionately. It's very important that there are broader social policy involved in this, either through, I don't know, some form of cash transfer or a multitude of other policies that can be designed for this. So yeah, exactly as I think Ronald said it best when he said that this should be seen only as part of a broader arrangement, a broader solution.
Thanks, Henrique. So let me jump back to the harmful tax practice, tax competition issue that we touched on at the very beginning. So Peter Jansky is here with us today, and he has worked with the Tax Justice Network as well, I think together with Lucas and others. So Peter, what are the main tax incentives used by European tax or European jurisdictions behaving as tax havens, to be more friendly, in order to lower effective tax rates? Because here the crucial question when it comes to harmful tax competition, it turns to be effective tax rates, right, rather than lowering statutory tax rates. So what are the mechanisms that you see that are implemented by European jurisdictions to lower effective tax rates that should be considered and are considered part of harmful tax practices?
Thank you, Agustin. It's a great question. For those who don't know me, hi from Prague. I'm Petriansky, Charles University. So, as we discussed previously with Agustin, we're looking at, what one way of framing it is tax expenditures. We're looking at costs of corporate tax avoidance. The specific question you asked is a great question, and I wish I knew the answer, and I don't know it. So it's fortunate that we have so many knowledgeable people in the audience, and perhaps somebody can answer it when I can't. So, for example, in some of the recent research with my colleagues, Javier Garcia Bernardo and Tomas Torslo, we estimate kind of, let's say the difference between backward-looking effective tax rates and statutory tax rates, and tax expenditures are partly responsible for that. But kind of, I haven't seen good cross-country research that would establish which specific tax expenditures or other specifics are responsible for how much, and that's what I understood was your very good question. And so maybe somebody else can feed me with that. But I have difficulties even thinking or coming up with a good research design where we could provide the answers to these questions.
So in your research, you observe the difference between the statutory tax rate and the average effective tax rate, but you really cannot see what is triggering or mainly triggering that difference.
That's right. That's right. Okay. So we are relatively confident, for example, that Luxembourg, that you mentioned earlier, has an average statutory rate between around 2015 of 25-28%. And we know that the backward-looking effective tax rate, we're reasonably confident, is somewhere between 2 and 8%. And so this is a quite big range, but it's still quite way different from the statutory rate. And we don't know what's behind this difference specifically. So, for example, thanks to LuxLeaks, we know that tax rulings are definitely one of the candidates. Due to some of the state aid investigations, we also know the specific companies paying for specific reasons the effective tax rates are lower than the statutory rates. But these are case studies, and we are not able to establish it in aggregate how much of these are account for how much. So hopefully that clarifies it, and I would welcome anybody's numbers or anybody's ideas for specific research design, how we could arrive at more satisfactory answers.
Yeah, totally. If anyone among the audience have any insights on that question, that would be interesting to hear. Lucas, so I know that within the index, there are some indicators that are explicitly related to tax expenditures, tax incentives, right? There's one that is fully focused on patent boxes, actually, coming back to our debate, but also special economic zones and tax exemptions. So maybe you can tell us a bit, without getting too technical, how you compute that and how those indicators, particularly related to tax incentives, tax expenditures, impact on the index.
All right, so both all three indicators that you mentioned, the one on exemptions by economic sector and the one on tax holidays and economic zones, and the one on patent box, they are all part of like a single pillar. that is called loopholes and gaps. So this is one of out of 5 pillars that is combined into a qualitative measure of tax havenry, and then this qualitative measure is combined with a quantitative one that is calculated on the basis of outward and inward foreign direct investment. So this is how the how our data on tax incentives is fed into the index. With regards to more specific exemption regimes in the EU. So what we see, as it has been mentioned before, is that like the patent boxes are pretty popular in Europe, but they are all subject to these nexus constraints. However, we see like 2 very particular cases that, as Peter said, that the real tax rate differs a lot from the statutory rate in Europe. So these 3 cases are Latvia, Estonia, and Malta. So this is because like they have like a constructive exemption for all economic sectors for retained income, meaning that like this is for Latvia and for Estonia, meaning that like when a corporation accrues income, that income is not taxed. There is only a tax that would be the traditional dividends taxation or tax on a distributed income. With regards to Malta is the opposite. There is like a tax upon accrual, but then when the profits are distributed, there is like a tax credit that is imputed. So like basically like the tax that you pay upon accrual is paid back when you distribute it. So like in these 3 countries in specific, like the range of tax incentivization is almost infinite, because in any economic sector, but mostly in those that are geographically mobile financial and business services activity, they are fully tax exempt. So that's what I can say about like the main results.
Thanks, Lucas. Peter, wanna jump in again?
Yeah, yes, happy to. And I think Lucas has described the basics of the corporate tax haven index very clearly, and it's a great tool. And I'm saying that not only because I had some input into it, but I think also that the big effort of Tax Justice Network also clearly shows that it's very difficult to do what I mentioned earlier. So they'd like to do. They'd like to quantify each of the tax expenditures, tax incentives involved, but they are not able to. And as Lucas described it, so they're combining the qualitative and the quantitative separately, and only then combining them. Whereas ideally, we'd like for each of the qualitative elements, we'd like to have a quantitative part, and that's hard to combine. They are devoting lots of resources into it. I'm looking forward to Agustin, to the database that you've been developing. I'm also involved, or I'm following the development of the similar database at the World Bank. Is the inventory of corporate income tax incentives that some of you in the audience might be working on or be familiar with. But also, I'm kind of not so optimistic about what answers that database will be able to answer. And there's huge resources going into it, and still the answers that can be derived from it are limited. So yeah, researchers says we need more research. Yeah, hooray.
Sure. Yeah, that's what we are working on. Sure, fully agree. And maybe let me bring the COVID-19 topic to the table, because it's clearly a game changer, huge impact, and we have not touched on that yet. So, so clearly most of business have been hit very hard by the impact of the pandemic. But we do observe that some companies, such as supermarkets or online retailers like Amazon, for instance, have actually made extraordinary gains during the pandemic. And some commentators, but even some governments, like the UK, are at least considering the introduction of an excess profit taxes, a one-off, even called Amazon countries. So I would like to have your thoughts on that, Ana, maybe, where you think that this could be something worth considering as a one-off thing, or solidarity levies. One has been introduced in Argentina as a wealth tax, but this is more like targeting corporations that have been doing good throughout the pandemic. So what's your view on this? And particularly whether you think that this could trigger some undesired behavioral changes of these, firms trying to, engage on profit shifting in lower tax jurisdictions where, for instance, tax incentives are granted.
Thanks, Agustin. I think that's a great question and quite a difficult one to answer, I would guess. But I think, like as I said before, the COVID-19 crisis, what it has given us basically the opportunity to rethink, and I think we should use it like not to think short term about what type of revenues we can accrue as a one-off, but more of what type of tax system do we want to build for the future. And in doing so, I think in principle, trying to have, like we've just been through the first few phases, which has been mitigation and containment. We've seen lots of public expenditure that has been funded by debt. And I think like it's more, it seems to make more sense to think of how we can build a tax system in the future, how we can build it to have a more resilient economy in the future, rather than having these one-off taxes, which is, completely up to the different governments to introduce. But I would say that the longer term thinking of where the tax system should go, it's probably beneficial.
Thanks, Ana. Yes, Lucas, you wanna kick in? Go, please.
Yeah. So with regards to COVID measures, I think that one that should be mentioned pretty specifically is rental income, because in many countries, business that are forced to close still have to pay rents, and this is causing the bankruptcy of many businesses that are then either purchased by larger companies. So there is like a movement to concentration. So I think that either levying like a high tax on those passive rental income, or should be like a way to go.
Yes, Ron, please.
I would be quite worried if countries started to move unilaterally to implement these sorts of one-off Amazon taxes, because I think it will spur a lot of movement to places that don't do that. in the discussion about what is it that drives this wedge between the effective and statutory rates, to me, the biggest thing, and granted, I'm a trade economist, is its borders, its mobility. When we look at the impact of COVID on individuals in my country, people like me that are mobile, I could work in my office, I could work at home, I could work in a cafe if they were open. I'm quite mobile in what I do. But somebody who doesn't have that degree of mobility and can't earn during this period of time, they're getting nailed to the wall. When we think at a country level, countries that are based on services are very mobile. They're writing out fairly well. I saw a report this morning, apparently Irish GDP actually went up. Well, it's all because of the multinationals who are mobile in what they do. But you look at a country that's fairly, based on agriculture or based on natural resource extraction, where you can't do that at home, for them, COVID will play out for several years. And at a point in time where we're seeing vaccine nationalism on the rise, if we start seeing other sorts of movements on a tax level like that, I would be quite concerned about who's going to end up being left to pay that tax. And I don't think it's the ones we're actually after taxing. What makes all of this so extraordinarily challenging is the companies that we see with the most aggressive tax planning are the international ones. Yet taxes are still done at a purely national level. There is no WTO for tax policy. And until we sort of wrap our heads around that, I've said this before in various forums, we can shut down whatever methods we want and people will dream up tax, patent boxes. They'll dream up whatever comes after we rule out patent boxes again and again and again, until there is a supranational organization that has a degree of actual influence in how these things play out. Now, the WTO clearly has lots of issues with how it operates and the fact that it didn't involve developing countries in the early stages. But until we go that direction, I would be very nervous about individual countries taking these sorts of steps.
Okay, thanks, Ron. Good point. And because we are covering or discussing the heterogeneous impact of the COVID-19, for instance, in terms of how mobile we are on different type of workers, I've seen that in the chat, there's a bit of a heat debate around the phasing out of fossil fuel subsidies. Ron, I think you started the discussion and there are a few persons out there. So maybe you can actually share, Joe, Samit, and Dirk, if you want to contribute. And maybe because you're talking about how the social impact of phasing out fossil subsidies can play a role or not, maybe we can try to focus also on the COVID-19 and what the implications of COVID-19 and the pandemic would be for the phasing out of fossil fuel subsidies. If you have views, Joe and Dirk, I will be happy to hear from you.
Hi, you want me to say something?
If you feel like it.
Yeah, my quibble really was whether it's right to label these things fossil fuel subsidies, or whether I'm not quibbling about the fact whether subsidies are a good thing or a bad thing. That's a separate discussion. But I think we tend to call them fossil fuel subsidies, whereas most governments don't see them as that. They see them as helping groups or industries that they want to support. So, when we frame them as fossil fuel subsidies, we're already making an ideological statement, if you like, that I'm questioning. So that's one question. The other question you raised is what about post-COVID-19? I mean, it seems to me that post-pandemic, the priority has to be to get economies back on their feet and to stop millions of businesses going bankrupt. with the social cost that would entail. And for countries like the UK, you mentioned the UK earlier, talking about, they don't need the money. I mean, they can raise money for nothing. You know, the central bank is buying most of their debt anyway. Interest rates are practically non-existent. So there is no purpose in raising taxation at this point, because there is no financing issue. My own personal view is that taxation is not a financing mechanism anyway, and that we should think about it as an inflation control mechanism. But that's a separate discussion. So I don't really see, unless you take, again, an ideological view of, well, Amazon has made so much money through this pandemic, so let's suck some of it out. Well, that's fine if that's what you want to do. But I don't see any particularly useful economic purpose to be served.
Okay, thanks, Joe. Dirk, you wanna kick in regarding the fossil fuel subsidies? I saw that you were active on the chat. I don't know if you're still there, or maybe he left. Okay, you can follow the discussion on the chat. So yeah, so let me, I think we can have a final round of thoughts. Ana, Ron, Lucas, Henrique, any final thoughts that you wanna share with us to wrap up the event? Ana, maybe if you want to start.
Yeah, thank you. Well, thank you very much for this super interesting event. I think we've had a great discussion, and it's really, as I was saying, it's really coming very timely at a point where we really want to have the opportunity to think through, like, not only what to do in the future, as I just said before, but also what the tools are that we have nowadays in our tax system that don't work that well. And I think, like, maybe to wrap up, a concluding thought for me would be that we need to use this opportunity to review what we have, to review the tax policy mechanisms, to think about the future, and also, like, to bear in mind that tax is only one mechanism that we can use. There are other different mechanisms, tax policy tools that we can count on. Tax is only one factor affecting every investment decision. There are other non-tax factors that we should also think about when we're talking about investment. And I think finally, a key message would be for me that sometimes simpler is better. And so if we manage to have a tax system in which we basically have something very simple, something broad-based, something that ensures that that there's a level playing field effectively between the different firms, different firm types, and that minimizes distortions, that should be a goal, rather than having different menus of tax incentives that can create distortions one way or another.
Thanks, Ana. Thanks a lot. Ron?
I guess, I would first off agree with Ana that cooperation is what is necessary. And yeah, that and more data, more research, but let's also not lose sight of, we've actually had a pretty good idea about the direction we need to head. And, with luck, COVID will only last another year, 18 months. And it's important for us to strike while there is the political will for change. And, especially as people that really, really like talking about the nuances of policy, we can disappear down a rabbit hole thinking about the details of programs for the rest of our careers. But we've actually got a fairly good idea of the direction that some relatively important changes could go. And that involves cooperation, and it involves a lot of people taking the time to point out that there's actually a reasonable consensus among people that are actually reasonably experts in the area. And we don't have to agree on everything to make a meaningful change.
Thanks a lot, Ron. Lucas, some final remarks on your side?
Yeah, so
I muted, but it was me, sorry.
So, yeah, so I would go back again quickly on the fact that an absolute criteria of analysis is needed, because if not, we are missing many things, among others, zero tax rates, constructively available exemptions and such. And then I would call for more research on alternative regimes, not only tonnage taxation, but also those that apply in banking and insurance. For me, when analyzing like the tax rates that are applicable in these sectors, I was amazed to not being able to find what tax rate was applicable to banking and insurance companies. So that would be like a good research a direction if someone has the the time.
Thanks, Lucas. Thanks a lot. Enrique, on your side.
Yes, well, as a last point, I think, well, first to thank everybody who participated. I think was really interesting. When we're talking about tax incentives, I think it's, and also a lot of it from the perspective of civil society organizations, I think it's always important to highlight how let's say the blanket assumption that all tax incentives are harmful or negative, that is not correct, that it's really an issue about the design of those tax incentives and if they are, let's say, fit for purpose. And here I think we can also discuss about, input tax incentives that, are more cost-based. Perhaps they would have when we're talking and thinking about let's say, starting up the economies again after COVID-19, hopefully the soon things will start opening up again, the major role that fiscal incentives can play on that. So I think it's important to consider it as a very as a very powerful fiscal tool. But again, it must be designed properly. It must always be transparent, because unfortunately, what we have seen over the past decades is that there's a lot of opacity. There's a lot of political capture around it. So I would say that proper open dialogue is necessary to ensure that fiscal incentives can be used as they can. Yeah, thank you.
Thanks a lot, Enrique. And yeah, that's the whole idea of the purpose of this series, right? And just to wrap up and close, so next week at the same time, we will have the second event of the series with a focus on consumption taxes in Europe. We have also a great lineup of speakers. Paul Tang, who is the chair of the subcommittee on tax matters within the European Parliament, will be speaking. Also, Luisa Dressler, economist with the Tax Policy and Statistics Division, Anna's colleague, Marco Fantini, chief economist of the VAT unit with the European Commission, and Lourdes Sanchez, who is senior policy advisor and lead with IISD. So we will be discussing consumption-related tax expenditures, focusing on VAT and energy-related expenditures. So also looking forward very much to that discussion. Thanks a lot, our speakers, but also all participants for taking the time. It was great, and I hope you enjoyed it as well. Thank you. Have a nice one.
Bye-bye.